Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 62 of our Capital Mind podcast. Today's episode is actually about short selling. There's been a lot of news about short selling recently, some interesting rumors around it. So we wanted to get into the topic a bit more. And so without talking about stuff as it happens today, we'd like to maybe take a broader look about short selling, what it means, how it works, some famous instances from the past, and see what lessons we can draw from it. So Deepak, thanks for coming in for this. And so let's just dive into it. What is short selling and why do you not like how India deals with it? Or let me start. What is short selling?
Shrey, the concept of short selling is from the oldest concept is you buy something and then you sell it. So you have to own something. And if you don't own it, you can't sell it. But what if I could sell something that I don't currently own? If you look at the concept of a history, or if you look at the history of what stock options are, stocks are, the idea was you can do two things. You can always do something called a transaction and a transfer. When I say a transaction and transfer, it means I agree with you on a price. This is an acceptance of an agreement that between the two of us that we are agreed upon on the price of something. Then I have to transfer that something to you, and you have to transfer the price, the amount that you want to pay to me. That means at the same time, this is called a spot transaction. The immediate transaction is at the same time that I transfer something to you, at the same time you transfer something to me. You do this when you buy something in a shop, you transfer money, they give you the goods that you bought and so on. If I told you that, Shrey, you can do a purchase transaction today, I can agree on the price, but I can do the transfer transaction a little bit down the line. It could be an hour down, it could be a month down, a day down, whatever it is. You end up with a situation where I say, I will do the transaction of the price today, but I'll do the actual settlement, the transfer of this item on a later date. So, there's a good reason why this happens. So, for instance, one of the biggest reasons is you simply have, let's say you're a farmer that grows tomatoes. You've planted the seeds today. And only when you've finished, the tomatoes will be ripe is when you can sell it to me. However, you want to lock in. I'm a restaurateur that wants to buy tomatoes. And I'm like, listen, if I can work out a good price, I'll know exactly how to price the items on my menu because I've locked in the price of tomatoes from you for the next season, let's say. So it's in my benefit as a buyer to lock in the price. It's in your benefit as a seller because you might say, listen, now I know exactly how much I'm going to get for the tomatoes, but I don't have the tomatoes to give right now, and I don't have to give the cash as a purchaser either. We exchange the money later when you deliver the tomatoes, but we just agree on the price right now. This short selling, you as a tomato farmer are the short seller of the tomatoes, and you will actually produce and deliver the goods at a later date.
So these are futures, right? In a sense, I mean, this is what a futures contract is. Or
forward
contract
is.
I mean,
forward futures. There's some of the concept is similar, but the idea of a future is simply that the transaction settlement happens at a future date. In India, you have futures on commodities, you have futures on stocks, you have futures on indexes, you have futures on currencies. So the idea being the same, I will buy sell dollars because I'm an exporter, let us say. My customer promises to pay me $100,000 in July 2024. I will go to the market and say, is there a July 2024 maturing future contract where I have to deliver dollars on June 2024 or July 2024? And I can sell it right now. So they will give me a price of, say, 84 rupees. So I know that I'm going to get 84 rupees. Now, even if the rupee goes back down to 76, I'm still going to get 84. If it goes up to 89, I'll still get 84. So for me, the price of 84 is locked in. As long as I'm comfortable, because for me, it gives me a comfort that I know what money I will receive in rupees so that I can pay my salaries and make sure that all my economics is all right. A future is just a form of a forward contract that is transacted on an exchange.
Since you brought up exchanges, I think one question I had, or one point you had raised earlier, was when it comes to people like market makers and so on. So futures or short selling, this isn't something that you just use necessarily for speculation. By definition, many of the participants in an exchange, like a market maker, could be doing stuff that's kind of like futures or short selling or whatever, only for liquidity, right? So could you talk about that a little bit more?
Yeah. In fact, so the most important part about short selling is to understand why people would ever do this. So one of the basic concepts is one side of a transaction can be a short seller, the other side need not be a short seller. One of the reasons why you have a problem is this. Let us say I want to sell a lot of shares. There's a market maker in the market. I want to buy a lot of shares, and when I'm buying them, there is no seller available who actually has the shares, but there's a market maker involved. That market maker says, you know what, Deepak, I'll sell you these shares. The price is 101 rupees, and you can buy it at 101. An hour later, there is a person who actually has shares who's willing to sell. So what has happened is somebody has short sold, the market maker short sold to me at 101. He will now want to buy it back at lower. So he'll say, I will buy it from you at 100 rupees and 50 paisa. Now, if I had waited, I would have got 100 rupees 50 paisa for the share, but I didn't have time to wait, so I bought it at 101, and the market maker took it from me and then sold it to the guy who came 1 hour later he bought it back from the guy who bought it, came in 1 hour later, at 100 rupees 50 paisa. He effectively was a short seller for 1 hour. So this is one side of a transaction being a short seller, the other side is not. Why would a person do the short selling in the first place? Because the timing of people who actually own shares and the timing of people who do not can be widely different. Now, the word market maker sounds like, how do I become a market maker? Do I have to pass a test? The answer is no, anybody can be a market maker. You can be a market maker by just going in and saying, I'll short sell a share that I don't own today, but I'll buy it back by the end of the day. This is perfectly legal for an individual to do. However, like institutions like ours, like as a PMS, you're not allowed to sell shares if you don't already own them. So my brokers and my custodian will reject a transaction in which I have short sold a share I didn't own as an institution. However, as an individual, as Deepak Shenoy, I can do this. As Shrey, you can do this. So you don't have to actually sign a contract to be a market maker in India. In the US, you actually have registered market makers from the old days. But let's say you went a little bit further and you said, listen, I don't like this company for whatever reason. I think the price is too high.
I was just going to come to that. So this is now, can I just use the word speculation? I know people use that word very negatively in the sense, but this is actually speculation. You're just betting on a company failing, right?
Yeah, or a company being too overvalued. So, for instance, you might just say, Deepak, I think this price of this share, and this share could be called whatever it is. I believe that this share price is way too high. It has run up too much. This company is not going to be able to, perform in terms of actual returns at the same level that you believe it will. The market is expecting it to. So I might short sell the share. Now, this is a very common occurrence. You're not actually trying to say, I am bridging the difference between a buyer and a seller. That would be a market maker. You're not saying that I'm shorting a share for I'm short selling a share for any other reason. I'm short selling the share saying, I think the price is too high today. I will be able to buy it back tomorrow at a lower price. I will do it's a speculation. And there is nothing wrong with this.
But you say that, but why are we okay with you betting on the demise of a company? In that sense, because it's not just idle betting, passive, like me and you sitting and watching a cricket match and betting on who's going to win, who's going to lose. But when you make this bet, you actually impact the outcome a bit as well, right? To some extent.
Oh, yeah. So, in a sense that your short may actually influence the market if you are loud enough or heavy enough about it. And there are many reasons why you might be. Short selling in general is so unintuitive that it's not done by most people. It is not done by people who say, listen, this stock should go down a little bit from here. So let me drag the price down by just selling it and selling it hard. But it's a very difficult thing for people to do. But I think it also takes a lot of character to go in and short a share saying the price is too much, because we've seen things in the market where prices just go berserk and then they can take inordinately long amounts of time to reverse back to those regular values. So it is speculative. in a way, it bets on the demise, but it doesn't necessarily have to, because I think there's a difference between a fraud and a difference between a company that's just temporarily overvalued. A company can be temporarily overvalued because for some reason, it's been added to an index. And when it was added to that index, the volume of index funds that came and bought that stock was so heavy that they took the price up. Now, you want to be on that saying, this is insane. This can't go up 10% just because the index, it was added to an index. How does that change any fundamental characteristic of the company? So I am going to short sell it. Once the buying from that index fund situation dies, there are no buyers left. So if there are more sellers than buyers, effectively you get prices that are spiraling downwards. So the short seller at the top becomes the beneficiary of a short position, which is speculative. Again, perfectly valid. The reason why you shorted was not because the company was bad. It was because the price was bad. In some cases, the company is bad and you don't like that company for whatever reason and you feel that company should go to zero or whatever it is, and then you shorted. That would be betting on the demise of a company. But, in the lines of capitalism, you have to have destruction if you have to have creation. So you have to have creative destruction. Otherwise, there's no capitalism.
I think one question which I have is that high frequency trading, does that also have an element of buying short or selling short and so on? I mean, or not so much. I mean, because when I was thinking it through, the high frequency traders, maybe they're a bit more like market makers, but just wanted to hear your thoughts on that.
Yeah, in fact, high frequency traders do end up taking these short selling positions for short periods of time. Sometimes they are, we have a situation where there is not so much maybe speculative short selling. One of the reasons, for instance, it could be I'm looking at an HDFC bank and an HDFC, to give you an example, or a Bajaj and a Bajaj Finance and a Bajaj Finserv. Now, largely these stocks should be interrelated because HDFC owns 24% of HDFC Bank and Bajaj Finserv owns Bajaj Finance. They should move in tandem, but sometimes they're not moving in tandem. You're seeing one stock go way above the other. For whatever reason. So you might want to short sell one and buy the other because you believe the object will get bridged. A lot of high frequency trading does this at very short term intervals because some stocks that should move in tandem end up moving away from that zone, and they're taking the risk that this could widen even further. But the reward is that they come back down together. So that's perfectly. High frequency trading is just the same concept, and if you think about it, nobody has a problem with the motive. Nobody cares about the motive of why you're short selling, and whether it is high frequency or low frequency. Mostly the problem happens around what is short selling and is it a bad thing is how the thought process goes, I guess.
Yeah, I mean, you were telling me about Paul Tudor Jones and how he had, he was in a sense, called out and tried his best to hide this. So can you talk a little bit about why is it bad? I mean, what is the problem? I mean, my issue is that I don't know if you... maybe I should just pause and let you talk this through. But what is the issue people have with short selling beyond maybe, pushing prices a bit down?
It's quite interesting because it's not just India. It's worldwide. Paul Tudor Jones was one of the biggest examples. One of the things with Paul Tudor Jones is that he was a very good trader and he is probably still continues to be, I don't know. But one of the things he did in 1987 was he went short when the market was in the beginning or the middle of 1987. In October, there was a single day in which there was a 22% crash on the Dow Jones index itself, which is quite huge, or the S&P 500, I don't know, maybe or both. So the interesting thing that happened at that time was he decided that the world should not know that he was short that day because there were so many people blaming short sellers that they were saying short selling is unpatriotic, it is un-American, it is going against principles of whatever, Americanism and all that stuff. So he decided that he's not going to reveal that he was short. There was a video documentary made of him. He actually went to a lot of lengths for over 20 years trying to make sure that video does not go anywhere. He got that video taken down. He bought physical copies of that video before the internet so that people couldn't get access to it and so on. Because again, he was uncomfortable with this tag saying he shorted something. It's only after movies like The Big Short where the short people have been, given some kind of bhav. But otherwise it is, the bad news about short selling is like this. And it's true also. Let's say I spread bad news about a bank, and the bank is a perfectly fine bank. But it was going through a process where it's saying, I'm upgrading my ATM software. I spread the news that this bank has no money, so its ATMs does not give any cash. During the time when I spread this rumor, the people start going to the ATM to the bank, and the bank, naturally has a down time so they see that these ATMs are not working. They start spreading it around on WhatsApp to all of their friends saying, this bank is gone. Please get your money out as soon as possible. There's a run on the bank on Monday morning or whenever it is that the next day. They are actually standing in lines just to take their money out. If there's a run on a bank, no bank can survive. So eventually when the bank can die just because you spread the rumor that the bank is bad. What if I took a short position on that bank and then spread this rumor? I can profit because that bank's stock price will fall because it's either going to go be bust or going out of business. I have short sold it at a high price. I can buy it back at a much lower price. And then, of course, if the bank recovers, it recovers. If it doesn't recover, it doesn't. So this is what people feel the short people do, is that they come in and they ruin the reputation of something which is perfectly nice and legal and happy. And that's the conspiracy theory that, people believe that would, destroy the example. I think you have an example of this.
Yeah, I saw. I can't remember the guy's names, but the same person who basically caught Bernie Madoff, I think, wrote something about GE, where he said this is an absolute fraud. And this is already like just a year or two ago when GE was already like 90% down from its peak and whatever. And that day the stock price did fall very significantly. And it seems to have, apparently it has since recovered. And I guess the point is sometimes the short seller can just be wrong. Like, I mean, as in the example you give, there's some malintent, right? But the guy can actually just be wrong. But if you're credible enough, you can, in a sense, ruin a company or hurt a company for no fault of theirs because you're going around essentially making other people panic. And so maybe that's where the thing comes is, I remember reading one example that if you tell me everything's well, then all is fine. But if you tell me why one company in my portfolio is doing accounting fraud and this is why you need to pay attention to it, then I will clear my calendar. And I read this in some book recently. And it's like you just deal very differently to bad news. And so I get it. So my example was this GE one where it would turn out that maybe it's not a great company and maybe the stock isn't great. But whatever accusations of fraud were wrong. And so people who read that panicked and sold were, in a sense, were ill-informed and it was not well done. I mean, I think that's... Of course, we don't seem to have a similar equally bad thing on the upside, right? If you write a glowing report about a company and it doesn't come true, there's not that much backlash. Is that correct?
That's almost always true because, people look at... like, for instance, there's no backlash that, I think this company is great. But you know what? Because you can always go back and say the market has not recognized it yet. There is no such thing. But if the guy writes something bad about a company and the stock price does well, you're screwed. The problem is shorting is asymmetric in the sense that your core concept is when I short something, the max I can make is 100%. But when I go long on something, it can go 2x, 3x and 4x. So if you're short and it goes 2x, you can lose 200% of your money. You can lose more money than you actually have put into the short, right? So effectively, a shorting person has to have the ability to take much higher losses. Because also now to buy something, for instance, you could buy one share. In India, if you have to buy a future or short a future, you have to do a significantly larger size. So typically the typical size of a contract is above 5 lakh rupees. So that means you should have the capacity to short something for 5 lakhs. Of course, the margin requirements are probably only 1 lakh. But that's still 1 lakh rupees minimum you need just to short something, other than if you're doing it intraday. This margin requirement increase also makes it more difficult for people to short. So not only is it an asymmetric bet, it's a costlier bet for people to short something. So the returns need to be so good that the person who's shorting it better be aware that shorting is a good thing.
Well, also has to happen now, right? I mean, you can be right, but if it happens a year from now, you've probably lost interest and lost a lot of money along the way. I mean, yeah.
Yes. In fact, it's happened in Tesla's case, and I think we'll go through it as we go along.
I think the next point I had written down to speak to you about was, so can you talk to me a bit about the procedure? So or my options, how do I short a stock? Let's say I come and I hate a stock XYZ. How do I short it?
Yeah. I think, here's the thing. For instance, you could do an intraday short, but then you have to cover your position by the end of the day. Intraday short is just between settlement periods. period. So a settlement period is 1 day in India. So if I sell in the morning, I have to buy back by the evening. Otherwise, I have to have settled it. Settle means if I have to sell it, I have to give shares in India. So you can sell it in the futures market. Now, there are only 200 stocks on which there are futures. So it's a limited, set of things. And it's a different market from the stock market. So a stock can trade and a futures can trade. India is the largest single stock market in the world. So a stock can trade, Reliance can trade at 2,300 rupees, and Reliance futures can trade at 2,315 rupees. Now, typically, the reason why there's a difference is because there's a cost of carry. That cost of carry is how much, instead of buying Reliance today and paying 2,300 rupees per share, I can buy the futures and pay only maybe 600 rupees per share, and the remaining money I can produce only at the end of the month. Now, that 1,800 rupees or so, which is the extra money that I did not pay, is essentially earning me interest for the remaining month. That interest has a cost, and that cost is called the carry. Now, futures expire on the last Thursday of every month in India. So you have to wait. You have to carry the future till the expiry date, and the difference between now and then, the interest cost of it, which is the overnight interest just multiplied by whatever number of days you have, is typically included in the carry. So something that has, let me give you an example. If you have a 12% interest in the market, it's not 12%, but I'm just using it for this thing. That means 1% per month. So if there's exactly 1 month left to maturity, then a 2,300 rupee future should trade at 2,000. If the stock is trading at 2,300, the future should trade at 2,323, because 1% more, 2,323 is, and the 1% more is exactly the cost of the carry. But sometimes it trades more or less than the cost of carry. The reason for that is, if it's trading at more, that means more people are interested, believe that the stock will go even further up than the carry. That could be because a company is going to announce results, or they feel something important or exciting is happening. Just speculatively, people have been buying the future instead of buying the stock. The second part can be that the future price can be considerably lower than the carry. It can be 2,310, for instance. And now you're thinking, wait. If I bought the future at 2,310, it's better because I could keep the remaining cash, and However, the answer is not so simple. What happens really is that there's a reason why people may have shorted the future, because they can only short the future. And that future shorting is because people feel something bad is going to happen to the stock. So sometimes the cost is less than the cost of carry. Sometimes the difference is more than the cost of carry. Essentially, the most commonly preferred way to short in India will be the future. But in US and most other places, single stock futures are not common. So what they do is they do something very different from what India does.
Do tell.
Yeah, so the concept over there is, instead of using futures, they say, listen, you own stocks. Can I borrow them from you? And I will sell them in the market. I've effectively short sold. But it's not short sold in that context. It's just that it was not my share. I borrowed it. So when I borrowed it and I sold it in the market, I have a promise to return it to you at a certain date. And you say, well, you know what? Keep the share for a month. I'm fine. And for the privilege of doing so, I'll pay you a certain fee. This fee is the short, fee that is available for borrowing. It's called a borrowing fee. Now, what is interesting here, and this is very complicated. Futures are a different market altogether, so they're not shares, right? However, let's say there are 100 shares of a company, and you owned all the 100, and I borrowed 10 from you and short sold them in the market with the promise that I'll give you back shares in a month. And let's call this person Radhakrishnan. Radhakrishnan buys it from me. Now, Radhakrishnan thinks he owns 10 shares. You think you own 100 shares, because although you've given me 10 to borrow, you know that I'm going to give it back to you. So you will record because if there's any dividends, it's yours. If there's any voting rights, it's still yours. So technically, you will say, listen, I own 100. And I may have lent out a little bit of 10 or 15 right now, but I still own 100. And Radhakrishnan thinks he owns 10. So two people think they own 110 shares. This is crazy. So we'll talk more about this, because it essentially ensures that this is not a zero-sum game.
Well, in this example, why would I bother? I mean, you've talked about a borrowing fee, but why would I bother lending my shares out?
Let's put it this way. You're a very long-term shareholder. You own Microsoft shares for the last 20 years and you want to hold for another 10 years. You are saying, listen, Deepak wants to short Microsoft. Please go ahead, be my guest. I don't care. I'm going to hold this share for 10 more years. Deepak Sharma is saying, I want to short Microsoft because in the next 3 days, I expect the earnings result to be negative and therefore the stock will fall 20%. You're like, I don't care. One earnings doesn't matter. I don't care. I'm not going to bother selling and rebuying my shares. So yes, Deepak, you can borrow my shares. Give me $1 per share for a $150 share and give me back the shares for a month. What happens here is you get that $1, that's like an extra dividend to you. If you're a fund manager that owns an index fund or an active fund and so on, you can lend out your stocks and earn an extra little bit of money by just lending it out. Of course, the lending cost is very, very small in India, in the world. So people saying like, anyway, you're taking the risk of the stock falling. So the fees that you will get for lending are the order of 0.05% or 0.1%, which is not much. But on a $1 billion portfolio, 0.1% is also quite reasonably high. So
And you will get it back, right? The other person is obliged to give it back to you.
in the US, what happens is the brokers ensure this happens. In India, there is an actual there's a system called stock lending and borrowing. Stock lending and borrowing system allows you or anybody of like you to borrow and lend their shares on the same platform, and with a guarantee that in case the other person doesn't pay it back, it doesn't give back the shares, the exchange will go and procure it from someone else. So the clearing corporation ensures that there's a settlement guarantee. And the problem right now is that in India, the system is very complicated. There are maybe 5 different ways you can borrow, lend even in the SLBS. There's a thing that has a 1 month period of lending. There's 2 months period, 3 months period. There are 2 such separate contracts which you can actually do, which is one is you have to buy and return it at the end of the month, and one is you can buy and roll it over for another month after that automatically at the current price. So it's a complicated system, and so complicated that current brokers, none of them have an interface that allows you to lend your shares in a one click.
So does this mean that shorting as it stands is fairly relatively new in India? Because this doesn't actually sound correct, because we've recorded an episode, I wasn't there for that one, where you've talked about how Dhirubhai Ambani outwitted short sellers and so on. So, is shorting new to India per se? And if so, given that it's so complicated, how was it done before this?
Yeah, shorting has always existed, just the instruments of how to short are different. So what happened in 1984 was, and we talked about it in the episode, there were people who started selling Reliance shares short. And that time the market was run by something called Badla. And the Badla is what eventually became the futures market. And that's how Reliance was shorted. So just a quick explanation of today we settle shares every day. So whatever you buy today, you have to settle it in the evening. If you hold it beyond 3:30 and the market closes, you have to produce the shares if you have sold them, if you have to produce the money if you have bought them. And then the other side will exchange it and so on. So at that time, settlement period used to be 15 days. That means at the end of the day, if you have a share, you could actually reverse the position the next day and it wouldn't have to get settled. And this would happen over a 15-day period. Now, if I bought a lot of shares and then, at the end, maybe 1 lakh rupees worth of shares. At the end of the 15-day period, I'm like, dude, I don't have 1 lakh rupees to pay. Can you move me to the next settlement period instead? That is Badla. So what the other party of this Badla guy does is he pays a certain fee. He asks for a certain fee. He says, well, I'll move your Badla, but here's the Badla fee. It is 1% for every 15 days. So 1% for every 15 days translates to 24% a month, which is typically what the interest rates were at those times. You would find even large players like Harshad Mehta using the Badla market largely just to make sure that they could keep prices very high. So with small amounts of money, the margin and the mark-to-market that is payable, they could keep seeing prices go up by not having to actually pay the full value for every share. They pay only a certain amount of margin and just keep doing Badla and paying Badla costs. The stock price, if it goes up more than 24% a year, you've earned the Badla. So that was the concept. But if I did Badla financing every cycle, I would actually be paying 18 to 24% a year.
So in the past, you've mentioned that this just sounds like a fun gambling thing, though, right? This doesn't sound like some way of running a business per se. Is this used for anything other than just gambling?
I mean, the Badla market and perhaps the futures market to a certain extent has largely been a financing market as well.
Can you explain?
So it's very interesting. You can let us say I need to sell something. I want to short sell something. I have a lot of shares in the market and all that. I can borrow TCS shares in the market and sell them, short sell them in the market. So let's say I put my shares, whichever other shares I own, as a margin. I just borrow TCS shares and sell them. I get money. That money is available to me as cash. Now you can lend it in different ways. For a Badla market, the idea was a certain amount of margin was enough to be able to short, and then you didn't have to produce the shares to short them, because the buyer on the other side was often just speculating on the shares, and therefore he always came back to you and said, "Badla kar do." Badla kar do means move the badla to the next cycle, which means on that whatever you shorted TCS, that you earn another 1% for every badla finance that happens. Now, for you, this is great because you don't care. As long as you don't care about the TCS share. Now, that TCS share could go up. It could make you lose money. But by and large, people you know in the market lose money. So they will go and over speculate on the wrong thing. So if you're a Badla financier, you just need to maybe hedge in the market in different ways. But over time, you know that people will over speculate. They will keep doing Badla financing, pay you the Badla fees, and you will make your money over time. So people can use this for a financial transaction of just being a lender. Effectively, Badla requires both of us to not want to settle and to for both of us to want to do this. In the specific case in Reliance, what the interesting thing that happened was Dhirubhai Ambani saw his stock price going down because the short seller was shorting it. He came and said, "I am a buyer." Then he went on the Badla time and said, "I'm not doing Badla. I am pay up." Now the other side was like, "Dude, you have to do Badla." He's like, "No." Then he said, "If you guys want me to do Badla, then you have to pay me a fee. It's the Unda Badla. It's the opposite Badla." So then they were like, "Okay, how much?" And he said 5% or something like that. He said very high rates. So they're like, "Nobody asked for 5%. I said, "I don't care. I'm asking. If you guys don't do it, I'm gonna I'm gonna have the exchange shut down." He made sure the exchange was shut for 3 days before this shit. And then those guys, they were like, "Okay, I don't have these shares to settle. So let us open the stock exchange for a day just for me to buy the Reliance shares so that I can give this to this guy." And apparently, the rumor has it that it was Dhirubhai Ambani who sold them his shares at 30% above the market price, simply because they were so desperate to buy anything. So this is basically this thing that happens. But
if I remember, okay, I get this one, but you have a less happy story when it comes to, if I may call it, Badla / futures exchanges and NSEL, right? Which made you semi-famous. You were quoted in some Supreme Court judgments. Can you talk us briefly through that as well?
Oh yeah, this was 2012 or 13. I think it was 13. I'm not sure. I think it was roughly that time. So NSEL was this great thing called the National Spot Exchange Limited, started by a guy named Jignesh Shah of 63 Moons. That time it was called Financial Technologies. What was interesting about NSEL was that you could exchange commodities. You could sell commodities there and other people could buy it. What happened was, the idea should have been, you have some wool to sell. You're a person who has wool in your warehouse. You sell it to me. I buy the wool from you and life is great. Now, why would I buy wool? I'm not even a wool guy. They want ordinary people to become market makers and traders in this thing. So what they designed was, let's design a contract in which you sell me wool and you buy it back from me in 15 days at 0.5% higher. Now, 0.5% every 15 days equals 1% a month, equals 12% a year. This is great. So I do a paired contract, a contract that makes me buy wool from you today and at the same time sell it back to you 15 days later. So there's a future contract and a spot contract at the same time. It's a swap, but effectively swaps are financing. So the idea here is goods are never exchanged, but then for the spot exchange to have functioned, goods should have been exchanged. So what they did was even better. Shrey owns a factory in which there's wool. Shrey tells there's a warehouse inside the factory that has a lot of wool. Shrey says, listen, Deepak has been sold so much wool, but that wool remains in Shrey's warehouse. And after 50 days, you buy it back from me. So we just exchange something called a warehouse receipt, which is the warehouse is in the cellars. The problem really was what if there was no wool at all? You could sell air, and people were.
But did it matter? Because we're just gambling in this example anyway.
Here's the best thing. Let's say Shrey never had any wool to begin with. Shrey sold me a contract at wool at 100, and then bought it back at 100 rupees 50 paisa. Then again, I did another contract where he sold it to me at 100.5 and bought it back at 101. At some point, this just ballooned up to, 5,000 crores. There were only 17 sellers. There were 15,000 buyers. So the buyers were simply people thinking there's actually wool happening and all that. There was no wool in any of the warehouses. What was happening was somebody was taking the money and then just rotating it. So what would happen really is, let's say Shrey sold it to me, you get the first 100 rupees and then you never get anything because you're just rolling the contract over, right? But Shrey could also sell another contract to Ashwin and to Vashisht and to all of these guys could buy contracts from you. So you just get another 100 rupees every month by finding another bakra, if you may. So in effect, if over time, all you're getting is... So the NSEL scam broke when eventually, when people figured out, a friend told me this, he went to this place which was supposed to have wool. It's called raw wool. And when he saw the place, the factory was covered with moss. Nobody had opened that gate for centuries, it seemed like. And he quickly ran away and he said, boss, there is nothing there. There's no warehouse. He's selling you air. And but it broke down because the government got to know about this. It was being sold like crazy. There were YouTube videos, influencer videos telling people you should buy wool. For 15 days you make, this much is guaranteed, back-to-back contracts. Except since there was only air behind all. There was no warehouse and there was no nothing. The government immediately banned everything and said, listen, you're a spot exchange. Why are you giving contracts 15 days later? The max you can do is like 7 days or something like that. That just killed the business.
What had they done with the money? Like they couldn't return it?
They couldn't return it because they made an elaborate plan saying we'll return so much money every so many days and so on. Many of them were connected politically, so nobody went to jail. I think the owner of 63 Moons did go to jail for a while. But that entire concept was propagated as a financing scheme. It was never meant to be a trading exchange, according to me. It was just a financing scheme. And because it was a financing scheme, a lot of people simply lost a lot of money because they were told, this is the scene.
Can a financing scheme ever unwind elegantly and in a way that causes no harm to people?
Oh yeah, if it's a real financing scheme that does involve something. I'll give you an example of how something that involves financing can actually change the game. If, for instance, I needed finance for a short term, and I was a genuine guy, I needed finance for the short term. But because of, say, stretched balance sheets, I was not able to obtain a loan by any way. And I went and did some badla financing to get some money, short-term capital, or I did something else like this to get some short-term capital, and I was able to turn it around and give back the money in a while. So I'll give you the biggest example. Let us say I'm a company that, for whatever reason, exports some software. My customers promise to pay me in 3 months. Except I need to pay salaries for 3 months. I don't have any way to discount that invoice because the banks don't like me or whatever it is. So I go to the Badla financing scheme and say, listen, I need 50 lakhs right now. And I will return back 60 lakhs in 3 months. But no bank is giving me a loan. No financial institution is willing to give me a loan. So a broker can just simply say, listen, we'll do this Badla financing thing. They'll do this financing scheme. And then return you can return the money over other things. It's an unsecured loan made by a broker. Despite having a person whose credit history is probably not so great, but that person was able to take that 50 lakhs and earn 1 crore from it. He doesn't mind paying 10 lakhs in interest because he's made another 40 lakhs in profits. This is rare, but it does happen.
So when used like a proper loan and a thoughtful loan, then this is something that could make sense. Otherwise, as you said, if it's gambled away on stuff which then vanishes, then, well, good luck. There's no money to be had in the first place.
Honestly, Shrey, if you do it once and you succeed,
you'll keep doing it.
It's free money, right? You're going to be like, boss, let's keep doing it. At one point, you lose money. And that's what happens. Greed just takes over.
Right. So then, all right, now starting to back up a bit, can you talk through? We were talking through examples of why you would go short. I mean, so maybe can you just articulate some framework around that? What are the different reasons for which you would go short?
So one of the reasons why you would go short, and many people do this abroad, is a stock is overvalued according to you. That overvaluation can come from the fact that you believe this stock does not have the cash flows people believe it has. Many times people have done this to Tesla. Now, there is actually a Tesla Q club. So this is quite interesting because in the US, if you put Q at the end of the name of a stock, that means the stock is in bankruptcy. So they believed that Tesla was so leveraged that it would actually become a Q stock. So there's a club called TSLAQ, some of whose members have actually banned me on Twitter because once I supported Tesla, they have blocked me on Twitter, which I don't understand. I'm like, why do you hate a stock so much that you will ban even a random guy from India talking good about it? But that doesn't matter. It's become a religion of sorts. But what happened after that was Tesla's stock went up 10x. So they were eventually right when it fell from 10x to only 5x. But it doesn't matter. If you're short at 1x, that means you've lost 500% of your money rather than 1,000% of your money, which is still a fairly large sum. So, that is one reason why you do it. You just say this thing is overvalued, it's going to go down, and boom, boom, boom. The other one is to say something is a fraud, where you're saying, I see this company, I think it's a fraud. Now, you've had this, a bunch of companies who you have a situation where this company is simply showing you bad accounts, has an accounting shenanigan. You've discovered something that found that you think that the company deserves to go down, and you highlight it out. So you might actually go short before you highlight it out. This is legal in the US. In India, it might be considered manipulating markets if you benefited from something like this, which is why people in India don't do it and don't like to do it so much. One analyst printed a negative about a certain company in India, and he got arrested and taken to Gurgaon because he didn't short the stock. The hedge fund that employed him was in Canada. That company had shorted the stock through the FII route or something, and that since he was in India, they took him as an analyst to Gurgaon and all sorts of things and all. He was in jail for 15 days because they said you are manipulating the market, and because they couldn't go after the people who actually short the stock who were in Canada. So it's a very weird thing.
Quick arbitrage funds, do they short stocks, or is that a more technical thing?
No, that's actually, this is a great way to earn income. So for instance, I told you that if the cost of carry is 1% a month, then a future will trade at 1% higher than the stock. So what if I bought the stock and shorted the future at exactly the same time? I will earn the difference in income. Now, arbitrage funds are funds that short. In fact, they are the ones who hold roughly 30 to 40% of all the short futures open interest in India. This is so big that if you stopped arbitrage funds from doing this, there would be a big liquidity crisis in the futures market because there will be people willing to buy futures but nobody willing to sell them. So arbitrage funds, the reason they succeed is like this. Let's say you are able to make, in a debt fund, 8%. That 8% has a 30% tax if you sell it in the short term. So I want to hold my money for the short term. I will pay 30 or 42%. 42% is the upper limit, and 35% or something. 30% roughly is the lower end of people who actually do this stuff. So if you're paying 30% tax on an 8% yield, you're making only 5.6% net of tax. But if you go one level further and said this is a debt mutual fund, that would still pay the same amount of taxes if you got out early. What if we called it an equity mutual fund? An equity mutual fund has to have a 65% in equities. So you buy 65% worth of equities, short 65% worth of equities, and the remaining money can sit in some overnight fund or something like that. Overnight this thing. You can actually earn the same 8%. An equity fund's short-term taxation is only 15%. So on an 8%, if you pay 15% tax, you make 6.8 instead of 5.6. So which is like you're making a considerably higher amount. So if you put 1 lakh rupees in it, over a year in a regular debt fund post-tax, you'll make 5,600 rupees. In an arbitrage fund, you'll make 6,800 rupees. So what does the arbitrage fund do? It buys shares, shorts futures. So that's the other part. So this is an income-generating hedged position that you do in the futures market.
And arbitrage funds, they basically make debt fund-like returns, but at better taxation. Is that fair to say?
Yes, at far better taxation currently. They might change the rules, tax rules at some point.
Yeah, but that they could do for anything, right? I mean, I'm coming towards the end of my questioning. So I'm a foreign fund and I hate a particular Indian stock. How can I short it, or what can I do?
Oh, you can. For instance, you can come through this foreign portfolio investor route, FPI, and you can register as an FPI. And FPI again gets to short futures. You short it through the futures market, and then you make money on whatever happens at that point. You may, for instance, borrow short stocks in the SLBS market, but the SLBS market is so illiquid, people don't do it so often. What if you have Indian companies listed abroad? When those companies are listed abroad, they can borrow those stocks and short them. They can borrow Indian companies' bonds listed abroad.
But to short a bond sounds even riskier, right? Now you're assuming that this company is absolutely worth nothing or is actually going to go into bankruptcy. Isn't that correct?
Yes, for the most part, because that's when the bond would actually yield you a significant. Because, for instance, if I can somehow pay you back interest, then the bond price will never fall. It's possible that tomorrow the company may have to refinance itself at a higher rate. But if it can pay me back, it's fine. The only problem with a bond would be if the company can't pay you back. Howard Marks says this, in equity, you have shades of gray. You care about whether the company is good or excellent, because good gives you a certain return and excellent gives you a more than better return. And it can be bad and worse. So bad gives you a slightly bad return and worse gives you a horrible return. In bonds, your return is known. You know exactly how much you're going to make. But your risk is literally 100% on the downside, almost, or close to. Because you're estimating that this company will go bankrupt and have enough assets to pay me back a certain percentage of my money, which I can recover in a certain amount of time. Most likely, all these assumptions are wrong. So you have to literally say, I'll make my 8%, but I could lose 100%. That's the asymmetric bet there.
That sounded a bit like the payoff structure from shorting. But of course,
here
also, the most you can lose is all your money. But while shorting, you can lose a lot more.
A lot more than that.
Achha, okay. I'm winding up to my last few questions. Should short selling be illegal? What do you feel about that?
So I think it's not necessary. First, like we said, market making. If you don't have a market maker, the person is not allowed to short without owning stocks. You find liquidity issues because people will not come at exactly the same time in the market when they want to buy and sell shares. So I think that is there. Should speculative short selling be illegal? My answer is no. Because the worst companies in the world have actually been discovered by short sellers that they are worse. They are worse than you think. Enron, for instance, a short seller is the guy, Jim Chanos, I think. He was the one who asked, there was another analyst, I forget his name. The analyst asked questions in a conference call. And because they knew which company he was representing and that the company was a short company that was short Enron, the guy who was the president of Skilling, Jeffrey Skilling, he used a bad word. He used a swear word in a recorded conference call. And then people started to realize that something is wrong if you get so angry with a short seller that,
how can you lose so much composure in what is otherwise very formal setting?
Yeah, and in India also, I think there was a case of at one point Anil Ambani's stocks were ADAX stock were falling, and he was going around saying, no, these short sellers are dangerous. He went after some of them in terms of putting legal cases and this and that and all that, and eventually it turned out in both these cases, the short sellers were right, and there was accounting problems at these companies. And if a company is genuine, it is very unlikely that the short seller will succeed. That means the company has to be so bad. I mean, for instance, in India, if you like I told you the example of the bank that you could, but you have to be so powerful that you should be able to override not just the bank, the fact that the RBI will come after you if the case is genuine, the police will come after you if the case is genuine, and you're trying to manipulate stocks. And it's happened. There's a Netflix series about a company in Germany. I forgot what it was. Wirecard, yes, that's the one. In fact, the whole German media and press hated the Financial Times for employing a reporter whose job it was, and he wrote a book about it, and he said, they hated me for the fact that I was reporting that Wirecard is a fraud, because it was a fraud, and they refused to believe me, saying that all you're trying to do is destroy a German company. So it is a tough job for people who are on the short side. Even if they're right, they just get vilified.
And in that case, probably don't make any money because he was just a reporter. So
Yeah, in his particular case, in fact, the reason why he was exonerated was that he didn't profit from it.
all right, bringing this to us, can a PMS like us borrow and go short? And do we borrow and go short?
Oh, that's a good question because the rules allow, I think, some part of this, but not all. So, for instance, you can't leverage. So, while short selling requires lesser margins than the actual, if I short sell something worth 5 lakhs, I have to put only 1 lakh rupees as margin. In a PMS, you can only short that up to that. You cannot take any leverage. So, if you have 50 lakh rupees in your account, all you can do is 10 short positions worth 5 lakh each. Even though the margin requirement may only be 10 lakhs for it, you still cannot short more than 10 contracts. But
Well, this is to protect the customer, right? So that your PMS manager can't come back to you and say, hey, I know you gave me 10 lakhs, but now I've lost 20 lakhs, so pay me 10 lakh more to cover your account.
correct,
right?
cover your account. So that is one reason why. And secondly, they say that listen, you have to cover. Sometimes they'll say that you have to make sure that you're hedged in some way. So you shouldn't be able to lose more than your capital. You should have maybe call options to ensure that you don't lose more than 100% of your capital. You can't use leverage. You can hedge your positions using short. So, for instance, if I have a lot of shares of Reliance, I can short Reliance futures because I feel temporarily, Reliance is not going to go anywhere for a while. So, let me short the future and earn some income, the difference between the future and the cash price, over a period of, say, a month or 2 months. And I believe after that, Reliance is going to go up and then I'll take off my hedge. So, I can hedge it temporarily. You can buy options. Even mutual funds can buy options because buying options means you only lose a certain percentage of your overall
What you put
capital.
up for the option.
But mutual funds have rules about maximum option exposure can be 10% off. So you can buy put options, maximum up to 10% of your overall fund size. PMSs have a little more leeway, but I don't think I know anybody who's done like 100% options and all that stuff. And you can't do selling of options in any meaningful way as a mutual fund. As a PMS, you can, again, with the same restrictions of no margins. So it's actually not conducive. So, for instance, if I want to earn an income of, say, 12% to 13% a year, I want 1% per month. To do 1% per month, I have to leverage my portfolio. And PMSs are not allowed to leverage their portfolio. So writing options doesn't even make sense. Mutual funds can only do covered calls. So they will be selling options, which is effectively short selling a share. Selling a call is like short selling a share. But it's not easy for them to do it. In fact, mutual funds can't short sell an option unless they actually own the underlying shares. So it has to be fully covered.
So, okay. So they're done in a very, if I may call it, responsible and hedging-like manner, as you said. Yeah.
We can maybe borrow and go short. We don't know the rules. And in fact, one of the things that does happen is every customer needs to give permission for us to be able to borrow and go short because the money is theirs and therefore, they should be short. But the other part of this is that you can be the lender. So American mutual funds, for instance, they have this concept that allow the mutual fund companies themselves to lend out the shares and earn the income, which is beyond their fees. So they may charge the mutual fund a certain fee, but then anything that they earn from the lending process is theirs. This is how some of the largest ETFs try to make up extra beyond their 0.0001% or something like that. In India, you can't do that. So what happens is if a mutual fund lends out shares, the income that is earned belongs to the unit holders in the same proportion. So in the sense of the fees cannot be taken as the earnings cannot be taken out by the AMC or the fund managers like that. PMS also is very similar. If you can lend out your customer shares, you need to get permission from them. But if you lend out your customer shares and earn an income, that income can then be has to be given to the individual investor itself. So if you have 10 shares and I have 5 shares and our PMS lent out the 15 shares for maybe a few days and then got them back, the income made, 2/3 of it has to be given to you, 1/3 of it has to be given to me. It's just the way the rules are. And this also means that we'll miss opportunities.
No, I think given my experience with our PMS customers, they're probably very happy with that. I think...
because you don't want to be caught in a situation where you're losing 2x.
Yeah, I think people will show up at the office if that happens. So, acha. Last question, ending one. Short selling gone wrong. What's a short squeeze?
Oh, yeah, here's the interesting part. And maybe I should add probably one more point to the short thing before I get to the short squeeze. Then we'll talk about some stories, very interesting stories. So The first thing is when you short something through the futures market, if you're an AIF or a PMS that shorts it, it's considered business income. So let us say you wanted to hedge something. And we've been involved with a bunch of AIFs and all that have been on the wrong side of this. So I want to hedge something. I have a lot of long stuff and I have a lot of short stuff. So I have bought some stocks and they are down 50%. But I shorted some futures and the futures has made me 50%. On the 50 rupees that I gained, I pay 43% tax because I'm in the highest tax bracket, or the AIF, which always pays 43% tax, pays 43% of that 50 rupees as tax. Now, let's say the stocks go back up. You're thinking, okay, I paid 43% tax there, I can offset it with this. The answer is no, because on the gains, you have only 10% tax on the profits. So the timing of so if you made
I think it's worse than that, Deepak. I actually had an experience investing in a long short AIF myself, where the problem was also that these two books aren't allowed to talk to each other. So your gains on one can't be offset by the losses on the other as well. So you just end up with terrible taxation throughout.
Yeah, in the end, the taxes are what cause you to shoot yourself. Luckily for foreign investors, they're allowed to keep the same book. Indian investors can't keep the same book, so you end up with
that's
that.
Sad.
So shorting actually has this other tax angle where they hate you from the taxation point of view as well.
And if that wasn't discouragement enough, now you're going to tell us of how you can actually lose your shirt.
Yes. Now short squeezes are like basically the
Ambani story, but
the
worse.
Ambani story and worse. Yeah. So we've seen the Ambani story. Some people lost their shirts. In 2008, very, very strange thing happened. In 2006, Volkswagen was bought by Porsche. Porsche owned 34% of the company. They said, listen, we'll keep buying a little. We won't buy more than 75%. People thought, okay, well, Porsche is not going to buy more than 75%, so we're okay. By 2007, the prices of Volkswagen had gone quite high, and a lot of hedge funds said, listen, we should short this stock. Now, you have to look at the position. There was a company called Old Saxony or something like that, a fund, endowment fund or something like that, which owned 20% of Volkswagen. Porsche owned 34%. By this time, it had gone up to 43%. Suddenly, one day in 2008, it said, listen, I know we said we'll slowly increase our position, but then we had a lot of cash-settled options, which we are converting to a position which will give us ownership of the shares instead of cash-settled, which means we now own 74.1% of this company. Now, 74% by Volkswagen. Of Volkswagen is owned by Porsche. 20% of Volkswagen is owned by Old Saxony. There's only 6% left. Like I told you, when you do a borrow and short, more people can own the stock than they think they own it, right? So now suddenly only 6% is left. People who are short are like, guys, there's not enough shares left in the market. The price will go up. For a few minutes, Volkswagen became the most valuable company in history because the share price just zoomed up like 10x or 4x or 5x or whatever it was, some crazy number. So it was a short squeeze of gargantuan.
So the mark-to-market on your position would have probably obliterated your account.
Yes, and at these times, people who are short can go bankrupt right there, just overnight, just like that.
In minutes, actually, and you may not even know.
Which happened, which was very interesting because the nickel story that happened earlier in 2021 was similar, right? Because nickel prices went up. This Chinese guy was losing a truckload of money, and the Hong Kong exchange actually suspended mark-to-market requirements because if that guy went bust, the Hong Kong Stock Exchange would have to shut down. So they actually suspended mark-to-market requirements, and everybody who was making the profits on the other side was saying, listen, I want the money. They're like, no, we're not giving the money. So they waited for nickel prices to cool down. The mark-to-markets came back, and these guys who were supposedly genuine earners of those profits, tried to sue all sorts of things.
But they didn't get anything, I guess, or got much
less. They suspended the trading on nickel completely until the prices came down. So it is quite incredible how short squeezes work and how people react to it. And of course, the big example of GameStop. We saw GameStop 2 years ago, and GameStop was engineered upwards. So one of the things that happened in GameStop was a peculiar situation around options. In the US, if an option is bought, the market maker is required to buy as many shares because he has sold the option to you. He is required to buy as many shares as required to offset the delta of the option. So a delta is like this. So for instance, if a stock is priced at $20 and I buy a $20 call option, the delta, which is a Greek measure of how the option price will move when the stock price moves up by $1, how much was the option price move. So it says, well, something that is stock is priced at $20 and the $20 strike option has a delta of 0.5. So if I am a person who's selling, a market maker who's selling a $20 option for a stock which is at $20, I have to buy 50 shares because I'll sell 100 shares in the option. Each lot is 100 shares. I have to buy 50 shares of the option. Similarly, if somebody does it at $70, the delta is only, 0.1 or 0.1. What happens then is I have to buy 10 shares. But what interestingly started to happen with GameStop was a lot of people started piling on to the $79 and $80 options, forcing the market maker to buy 10 shares per contract. But 10 shares of an illiquid stock ended up pumping the price up all the way to $80 and beyond. And every time the price would go up, his delta would be off because he had bought only 10 shares. Now the delta has increased to, say, 20.2. So he has to buy another 10 shares. He causes the stock price to go even more, which causes him to buy even more, and so on. So the price went all the way to 200. The reason why they did this was because there were a bunch of hedge funds short on the stock. You can make out who's short and who's not. And then the guy who was short was a fund that was supposedly fundamental short, and this company was in bad shape and all that stuff. They lost $4 or $5 billion, had to be rescued to the extent where Robinhood and Interactive Brokers stopped trading the stock because they would have caused a complete stock market rout by not having enough margins to participate in the stock market anymore. Essentially, if Robinhood had continued to allow people to buy options on GameStop, there would be no trading allowed. Robinhood would have shut down literally. So when all of this stuff happened, the short squeeze drove that company to that fund to near bust. And then when that fund eventually had to unwind its positions, the stock price fell again. It's now back to about $80. Interestingly, GameStop...
Now it's at 18, by the way.
It's at 18 now? Okay, I had no idea.
So maybe the hedge fund, as you said, the hedge fund was right. Life happens.
Life happens, yeah. Interesting at that time that, all of this stuff happened, but it happened right in front of us. And we were almost cheering the guys who did it, but they squeezed out the shorts. In India, there was a story called Akruti Housing, which is now called, I think, Uptown, where the stock went from 600 rupees to 2,000 rupees in the span of a month. And on the expiry day, and I heard the story from the person who was on the short side of these things, who was being told by management or not by management, by whoever was going long on the stock that we will finish you. As in, you go bust. But he was also strong. So the price on the last single day fell from 2,000 all the way to 800 rupees. Imagine 1,200 rupee drop in the stock. And there was no limits because this company was in the futures market. And it was insanely volatile. That was a short squeeze of a fairly gargantuan proportion. There was still a lot of losses because somebody who shorted at 600 still has to buy back at 800, which is a fairly big number. But, you've gone crazy on the other extreme. Of course, the biggest other thing, which is the short case, there was a case called Amaranth, which Amaranth was a large hedge fund. And there was one guy called John Arnold on the other side. And John Arnold is a natural gas trader at Enron. Amaranth's CEO was another, I forget his name, but there's lots of books about that story where he said, listen, natural gas prices are going to fall. And John Arnold said natural gas prices are going to go up. The bet went on and on. They just kept adding contracts. And that year was a bad winter. So you ended up with natural gas being very heavily in demand and prices went up just to the point where this person who was going short natural gas went bust. And, eventually John Arnold made out like a bandit. He was the guy. Interestingly, John Arnold was the guy who rescued Enron. When Enron was bankrupt, they gave a bunch of traders a promise saying, listen, if you help us recover some of these massive losses that we've had to recognize in our accounting because of our bad accounting, we'll pay you a bonus, which is a certain percentage of it. He earned Enron $1 billion or a couple of $1 billion in a week or 2 weeks or some really short period of time. Enron reneged on his promise to give him this money. He was furious. He went out and started this fund called Centaurus, I think. Centaurus then went on to make 200% per year of profits for the next 10 years before he shut it down. He shut it down after Amaranth, a couple of years after Amaranth. He's now in philanthropy and so on. So the short guys do make out like bandits sometimes.
And sometimes use the money for good as well.
For good as well. So I don't think, in India, some of the biggest people we know, whether it is R.K. Damani of DMart or Rakesh Jhunjhunwala, they've all made a lot of money on the short side of things. And sometimes precisely because companies which are bad sometimes need this prodding or the short side speculation. If they had to be driven to bust anyways, in the sense of they're actually frauds, how does capitalism work? You have to weed out the frauds and you have to give power to the people who are not, right? So the only way you can get people to sell companies who are, if somebody is allowed to also take speculative short positions and put their risk capital behind it. So I think in general, it is not a bad thing to short. Short selling is not necessarily bad at all. There are very, very few times when they're actually vindictive shorts who basically destroy a company. But time has proved that genuine companies, the short sellers will always lose. And in bad companies, it's possible that the short sellers die before they win. So after you've lost all your money, watching a company go to zero has no meaning for you, right? But so it's an asymmetric bet even for the short sellers. So I think they deserve a due recognition in society for being proper players.
Well, after what you've said, I have to say, I walk away thinking, tread carefully, and maybe shorting only makes sense as a hedge rather than as a speculative position. I think it's too risky.
Yeah, I think it requires a superior form of trading to be able to sit through the volatility.
I think so. Well, thanks a lot, Deepak, and thanks everyone for listening. If you've liked what we've had to say over here and you'd like to hear more, visit capitalmind.in/podcast to see more of our episodes and listen to them. And if you have any feedback or ideas about new episodes, please send them over to podcast@capitalmind.in. Thanks for listening.